On one screen, stock traders cheer a rally. On another, a treasury auction lands with a dull thud. No sirens go off, no anchor lowers their voice. But that quiet corner of the market may be where the real danger is building. If you want to follow the signals that usually whisper before they roar, stay close to this channel, because the story you are about to hear lives far from the spotlight and much closer to your future than most people realize. When Ray Dalio warns that the bond market is the real crisis nobody is watching, he is not talking about some distant problem for hedge funds and economists. He is talking about the foundation under the whole financial house. The bond market is where governments borrow, where interest rates are judged, and where the price of time itself gets set. If that foundation starts to shift, everything resting on top of it feels the movement. Most people live their financial lives looking up at the visible floors of the building. They watch the stock market, they watch home prices, they watch gas, groceries, and maybe the balance in their retirement account. But beneath all of that sits the bond market, quiet and enormous, deciding how expensive money will be for everyone else. That is why this matters to normal people so much more than it seems. When bond yields rise, borrowing gets more expensive. A yield is just the return investors demand for lending money. If that return climbs on U.S. government debt, it tends to pull up mortgage rates, business loans, car loans, and many other rates right along with it. A lot of people hear the word bonds and imagine something slow, boring, and safe. That used to be part of the appeal. Bonds were the part of the market that looked like the adult in the room. They paid income. They seemed stable. They were supposed to be the quiet balance against stock market drama. But when debt grows too fast and trust gets thinner, even the quiet part of the room can become the source of the noise. Dalio's warning is simple at its core. The United States keeps issuing more debt. That means it keeps selling more promises to pay later. For years, the world was happy to buy those promises because the dollar was trusted, inflation was low, and America still looked like the cleanest shirt in a dirty laundry pile. But once debt becomes massive and interest costs start rising on top of it, the question changes. The question is no longer just, can the United States pay? The question becomes, at what price will investors still be willing to lend? That is the bond market crisis Dalio is pointing toward. Not a dramatic refusal on one single day, but a slow, grinding demand for higher compensation, more debt, higher yields, larger interest payments, even more debt to cover those payments. That loop matters because the numbers are no longer small enough to hide in the background. U.S. debt is now approaching $39 trillion. Debt held by the public, which is the part markets actually absorb, is more than $31 trillion. Annual net interest costs are now around the $1 trillion mark. That means the country is spending staggering sums, not on new roads, new factories, or new schools, but on the cost of money already borrowed. And the bill does not just sit there. It has to be rolled over. That means old debt matures and new debt must replace it. In plain English, the government is constantly refinancing itself. When rates were near zero, this felt manageable. When rates are much higher, that refinancing becomes more painful. Imagine carrying a giant mortgage and learning that each time you renew it, the rate is worse. Now zoom out and picture what this does to everyday life. A young couple finally saves enough for a down payment. They wait for home prices to settle, thinking patience will help. But then Treasury yields rise, mortgage rates stay high, and the monthly payment still feels impossible. They did not make a mistake. They simply ran into the bond market, even if they never once looked at it. Or think about a retiree who spent decades doing the responsible thing. She owns bond funds because she was told they are safer than stocks. Then rates rise fast, bond prices fall, and her account drops at the same time inflation eats into groceries, insurance, and utilities. She did not speculate. She followed the old rules. The rules changed around her. That is another part of the problem people often miss. Bond prices and bond yields move in opposite directions. When yields rise, old bonds paying lower rates become less attractive, so their prices fall. This is why a bond fund can lose money even though people associate bonds with safety. The label stayed calm while the math underneath turned harsh. For more than a decade after the financial crisis, the world got used to extremely cheap money. Central banks pushed rates down. Governments borrowed heavily. Investors chased return wherever they could find it. That era trained people to believe that debt could keep expanding because rates would stay low enough to make it tolerable. But history has a way of punishing assumptions that grow too comfortable. Inflation changed the mood. Once inflation returned, central banks had to raise rates to slow demand. That made new borrowing more expensive right away. It also changed investor psychology. People lending money to the government now wanted compensation not just for time, but for inflation risk and political risk. They wanted more yield because the future stopped looking as calm as it once did. Here is the uncomfortable part. The United States does not just have a debt problem, it has a debt addiction built into the way the system has been running. Deficits stay large. Politicians promise more than they are willing to fund with taxes. Voters want benefits without pain. Markets want stimulus when growth slows. And every time something breaks, more debt is often treated as the bridge to the next year. When was the last time you checked the bond market before checking the stock market? If that question sounds unusual, that is exactly why this issue is so dangerous. The things that shape your future most deeply are often the things nobody trained you to watch. A fair objection appears here. People say, the United States can always pay because it borrows in its own currency. And that is true in a narrow sense. America is not like a household. It can issue dollars. It can meet obligations in nominal terms, which means in face value dollars. But that does not remove the problem. It simply changes the form of the problem. If a country solves debt pressure by creating more currency, then the pressure can move from default risk to currency risk. In other words, maybe the bond gets paid back, but the money buys less. The promise is kept on paper while value leaks out through inflation or financial repression. Financial repression means savers earn less than inflation for long periods, so debt becomes easier to carry while purchasing power quietly shrinks. That is why Dalio's warning reaches beyond recession talk. A recession is painful but familiar. People lose jobs, companies cut spending, markets fall. Then eventually the cycle resets. A bond market breakdown is more unsettling because it touches trust itself. It raises a deeper question about the value of money, the reliability of policy, and the terms on which the future gets financed. You can already see hints of this in the way markets react to Treasury yields. A small move higher in long-term government rates can shake stocks, pressure real estate, and squeeze businesses all at once. Why? Because the Treasury market is the benchmark. It is the base rate from which so many other prices are built. When the base rate rises, the whole economy has to work harder just to stand still. Banks feel it, insurance companies feel it, pension funds feel it, startups feel it, home builders feel it, local governments feel it, even people carrying credit card balances feel it, because tighter money tends to move through the system like cold weather through an old house. Not every room cools at once, but eventually the draft reaches all of them. There is also the question of who keeps buying all this debt. For many years, strong demand came from foreign central banks, global investors, domestic institutions, and at times the Federal Reserve itself. But the world is changing. Geopolitical tensions are rising. Trade relationships are more strained. The Fed is no longer in emergency mode, and investors can now get decent yields in other places too. That means Treasury demand cannot be taken for granted. If buyers become even a little less eager, the government may have to offer higher yields to attract them. Higher yields mean higher interest expense. Higher interest expense means bigger deficits. Bigger deficits mean more supply, and more supply can mean still higher yields. This is the kind of feedback loop that begins quietly and then suddenly becomes the main story. There are other forces feeding it. America is aging, which means entitlement costs keep rising. Globalization is no longer lowering prices the way it once did. Supply chains are being rebuilt for security, not just efficiency. Defense spending pressure is growing. Political compromise is weaker. Productivity may improve with technology, but government spending commitments are here right now, and bond markets price what they can see. Imagine a small business owner trying to expand. He wants to buy new equipment and hire 3 more workers, but the loan rate is now far higher than it was just a few years ago. His customers are already stretched by rent and groceries. He delays the expansion. The workers are not hired. The machine is not bought. Nothing crashes on television, yet growth quietly weakens because the cost of money got heavier. This is how a bond crisis can spread without looking like a movie scene. It does not need a single day of panic to do damage. It can arrive as years of tighter conditions, slower growth, fragile confidence, and recurring moments of stress whenever new debt hits the market and investors hesitate. In many ways, that kind of crisis is harder to fight because people keep hoping it will fix itself. There are signals worth watching. One is weak Treasury auction demand. Another is rising term premium. Term premium is just the extra return investors ask for when tying money up for longer periods. If that extra return rises, it suggests buyers want more protection against inflation, policy mistakes, or fiscal strain. Another signal is when long-term yields stay high even when people expect the central bank to cut short-term rates. If this kind of quiet pressure is the sort of risk map you want in front of you before the crowd notices, keep this channel in your orbit. These stories rarely arrive with fireworks. They arrive with consequences. Now let's face the biggest reason many people ignore this. America has been able to carry big debts for a long time. Every few years, someone warns about it. Then the system keeps going. Markets recover. The dollar remains strong enough. Life moves on. So people assume the warning must be exaggerated. They confuse delay with safety. That skepticism is understandable. Timing a debt problem is hard. The system can stretch farther than almost anyone expects because the U.S. still has deep capital markets, military power, legal infrastructure, and the reserve currency of the world. Reserve currency means the dollar is still the main money used in global trade, savings, and finance. That gives America more room than other countries would have. But more room does not mean no limits. It means the limits arrive differently. Instead of a sudden wall, you can get a long hallway that keeps narrowing. The currency loses purchasing power. Financing costs rise. Asset prices become more sensitive. Politics get uglier because there is less easy money to spread around. The economy still moves, but with more strain, less forgiveness, and a shorter fuse. This is where the bond market connects to the bigger picture of power and world order. For decades, the United States benefited from a system in which the world recycled savings back into U.S. assets. America consumed, borrowed, and spent while the dollar sat at the center. That arrangement is not gone, but it is under more pressure now than it was when interest rates were falling and globalization was expanding. If global rivals want less dependence on the dollar, if commodity trade shifts slowly into other channels, if central banks diversify reserves even a little, if trust in U.S. fiscal discipline fades, then the Treasury market cannot lean as comfortably on old assumptions. The change does not have to be dramatic to matter. In giant systems, even small changes in demand can push prices and yields in meaningful ways. So where could this go from here? One path is the disciplined path. Growth holds up reasonably well, inflation cools, and lawmakers slowly bring deficits down, not to zero, just down enough to stop the debt from outrunning the economy so aggressively. In that world, yields can settle, confidence steadies, and the bond market remains strained but functional. This is the least dramatic outcome, and probably the most politically difficult. A second path is the quiet extraction path. Rates do not explode, but they stay awkwardly high or get pushed down below inflation for periods of time. Savers earn less than the true loss in purchasing power. Governments rely on inflation and controlled rates to ease the burden in real terms. The crisis does not look like collapse, it looks like erosion. The pain is spread out and hard to point at, which is one reason it is politically tempting. A third path is the disorderly path. Inflation proves sticky, deficits remain huge, and buyers demand meaningfully higher yields all at once. Treasury auctions get shaky, risk assets fall, credit tightens, the government faces rising pressure to choose between recession, money printing, or some version of both. In that scenario, the bond market stops being background plumbing and becomes the front page. Have you ever wondered how one move in a Treasury yield can travel all the way from Washington to a family dinner table? It happens because debt is not abstract. Debt is rent, payroll, refinancing, insurance, taxes, pensions, and the confidence people carry into tomorrow. And this is where a lot of viewers ask the natural question. If the bond market is so fragile, why do stocks sometimes keep rising? Why do consumers still spend? Why does unemployment not immediately explode? Because markets and economies move in layers. The bond market often pressures the future before the visible economy fully reacts. There is usually a lag, and lags are where false comfort is born. People often expect crisis to look like a switch flipping. In reality, financial stress often works more like water getting into wood. At first, the structure still stands, the paint still looks fine, the door still opens, but the strength is being reduced from the inside, and by the time everyone notices, repair is more expensive than prevention would have been. History keeps teaching the same lesson in different costumes. When debt rises faster than productive growth for too long, choices narrow. A nation can grow out of it, inflate it away, tax more, cut spending, restructure, or suppress savers. Usually the answer is some messy combination, but there is no magical door through which a country escapes arithmetic forever. That does not mean panic, it means clarity. Panic is emotional and often expensive. Clarity is different. Clarity says the bond market deserves more attention than it gets. Clarity says low rates were not normal. Clarity says a government's borrowing cost is not just a market number, but a social force that shapes who can buy a home, who can retire with dignity, and which businesses get to grow. For ordinary people, preparation begins with a mental shift. Stop treating debt as a topic only for economists and politicians. Debt is a force that can quietly rewrite your plans. It changes the value of savings. It changes the timing of retirement. It changes how much risk investors take just to keep up. It changes how governments behave when budgets get tight and promises remain large. Practical thinking matters here. Less leverage gives you more breathing room. Leverage means relying heavily on borrowed money. A larger cash reserve can matter more than chasing one extra point of return when the system gets unstable. Bond exposure may still make sense, but duration matters. Duration is a simple way to measure how sensitive a bond is to rate changes. Longer duration usually means more pain when yields rise. Diversification also starts to mean something deeper than owning a few stock tickers and a bond fund. It means asking what happens if inflation stays sticky, if rates stay higher, if growth slows, or if the dollar weakens over time. It means understanding the difference between nominal safety and real safety. Nominal safety means getting your dollars back. Real safety means those dollars still buy something meaningful. For retirees, that distinction is everything. A fixed income can look stable right up until fixed expenses start climbing faster than the check. For younger workers, the danger is different. Years of higher financing costs can delay home ownership, slow business creation, and make wealth building feel like running uphill. For governments, the danger is that interest crowds out choices. Money spent servicing old debt is money not available for future needs. Should everyone run out and make extreme moves because of one warning? No, that would miss the point. The goal is not to become dramatic. The goal is to become difficult to surprise. A person who understands bond market pressure does not need a perfect forecast. They simply stop building their life on the assumption that cheap money is guaranteed to return and save every weak plan. If you prefer calm signals over noisy predictions, this is a good moment to stay connected because the years ahead may reward people who can read pressure before they read panic. That skill may matter more than bold opinions. Ray Dalio's warning lands because it points to something many people feel without naming. Life has become more expensive. Borrowing has become heavier. The future feels less certain even when headline numbers sometimes look fine. That gap between official calm and private strain is often where the most important truths live. The bond market sits inside that gap. It is not glamorous. It is not social media friendly. It does not deliver easy heroes or villains, but it does reveal whether the system can keep funding itself on acceptable terms. And when those terms start worsening, the damage does not stay in finance. It travels outward into careers, households, elections, savings, and trust. So the next time the stock market steals the camera, remember to glance at the stage beneath it. Watch the yields, watch the auctions, watch the interest bill, watch whether leaders show discipline or just hope for another escape hatch. Because when the cost of money changes, the meaning of almost every asset changes with it. In the end, the bond market is not just about bonds. It is about the promise a society makes between today and tomorrow. And when that promise gets too expensive to keep, everything else starts to tremble.